There's lots of opportunities coming to market at the moment. In terms of the opportunities we're looking at, most of these companies are in fact small cap and sort of $1 billion plus companies. And you might be wondering why there's a picture of a bloke in his undies on this slide. This is actually step one. They produce underpants and they have a direct-to-customer model which sells directly to customers which they find on the internet, and then they supply the products to customers. And they don't actually have retail stores. They don't distribute via Target or Kmart. So we've been doing DD on that business. We think it's actually a very interesting business model. I have tried the undies, and we think that the runway for that business is actually pretty interesting into the US and UK. In terms of small cap stocks, GQG, which we've also been looking at, is a pretty interesting growth story. Rajiv Jain has driven that business and has a 25-year track record across global and emerging markets investing. And so he's managed to build a business which has gone from $0 to $86 billion in FUM in a very short space of time. Siteminder is another interesting company we've met recently. This one is a hotel software business. So they plug into the property management system for small hotels, and these property management systems are the systems you would actually interact with when you go to sign up or when you go to check into a hotel. And the Siteminder channel management software actually connects these properties, the property management software of hotels, with online distribution channels such as TripAdvisor and Expedia. So that's also quite a strong little software business. An illustration of this is, revenues last year only declined by 6% for Siteminder, which was, in the middle of a pandemic. So we think that's quite an interesting little software business. Happy to take more questions on any of these companies later. We'll take the next slide, please, Tim. In terms of the reporting season, we just saw, the issues that we encountered are probably, in the press and understood. Brendan Boyd can definitely talk to these in a lot more detail later. We have met Silk a number of times and have invested in that business and supported them from IPO. Supply chain, inventory build and labour shortages are all front of mind at the moment. And these sort of lead to inflationary pressures, which a lot of fund managers are thinking about and sort of thinking about the implications of inflation upon rates and what that means for valuations. Over the last few years, interest rates have sort of gone one way. And as they've come down, valuations broadly, particularly for tech stocks and property and infrastructure businesses, have actually re-rated pretty strongly. So when rates go up, we think potentially there is valuation headwinds for some of these longer dated tech stocks. And so having said that, we are pivoting the portfolio slightly towards stocks which are sort of lower valuations, but cyclical and still have some growth. Having said that, it doesn't mean we've sold all our growth stocks and gone to low PE cyclical valuation trades. We do have a broad range of both companies which are growing rapidly and also, companies which are still growing but trade on a reasonable industrial type valuation. Next slide, please. Just to give you an illustration of these companies across the fund, in terms of the micro cap fund, we do invest in, as I said, ARR stocks that trade on a metric of revenue, such as Nitro, which is growing rapidly and not quite profitable. But we do have a spread of companies which are profitable and are growing profits and are trading on sort of normal valuations. ProBiotech is a stock which I'll talk about more in the next slide, please. And this one is an industrial business and it trades on 12 times PE. Having said that, it is still a high quality business. These guys actually manufacture cold and flu tablets and analgesics for big multinational pharma businesses, which you would be familiar with, and you would have definitely interacted with some of their products, which might be cold and flu tablets. Imagine brands such as Benadryl. And so they manufacture these tablets in their production facility, which I've been out to in Melbourne, in Laverton. And then these tablets get packed through blister packaging and then sent to distributors. And so this manufacturing process needs to be validated, and the TGA has to validate each step of the process. And so this means that if you were to try and move the contracts, it takes up to 2 years and can be quite expensive to move. And as such, the revenue should be fairly sticky. Go to the next slide, please, Tim. So ProBiotech, these facilities that I mentioned, do require validation. And as such, these contracts can be time-consuming to move. These guys have also won contracts, which means that you will see growth just from the contracts they've won in future years. Furthermore, cold and flu tablets have definitely been challenged over the last year due to social distancing, which has meant that there's been less cold and flu circulating in the community. This should revert over the next few years, which will also help their growth from a lower FY21 base. These guys also do have 3 separate properties up in Sydney they want to consolidate. We think they can generate cost out. So over the medium term, for the next 3 years, we think these guys can actually grow their earnings at teens, and they're also paying a dividend. So you are clipping a dividend yield of 3%, which is unusual for microcaps, plus double-digit earnings growth for 12 times PE. We think that's pretty reasonable. Management, again, highly aligned. Management and the family own about 20% of the equity, which is that sort of skin in the game, which we like for micros. Next slide, please, Tim. AR Media is a stock which is more of the technology and growth end. This is, again, a company which has just turned profitable, so it is profitable. To illustrate what they do, I've included a photo I took, and this is of the final, actually one of the final sort of scenes of a Band of Brothers episode, which is a high quality TV series, which I would also recommend. And I took this photo at 3 a.m. in the morning when I was holding a 4-week-old baby that would only sleep when I was holding it. And as such, I was sort of holding her sitting in the couch, watching TV on mute, but reading the captions. And AI Media produce these captions. They have services which actually put the captions together, and then also technology which encodes the captions into the video stream. So AI Media, they actually disrupt the stenographer kind of market. It was historically done via a stenographer, which was very high quality, but did take a lot, was fairly expensive. And AI Media came up with the technology which actually cut the cost of this materially and has grown through this cheaper technology. Next slide, please, Tim. So while it does have people involved and does have some labor content, so it's not quite AI per se, it does have technology augmented sort of services in addition to a newer product, which is actually requiring less people and should be higher margin. So this should improve gross margin at a period of time where revenue is still growing 20%. This higher gross profit will generate much greater earnings growth as fixed costs should be fairly stable. So we think they'll get plus 20% EBITDA growth over the medium term. While it's trading on a valuation of 13 times EBITDA 2 years out, we think that's actually pretty good for quite a strong, sticky earnings profile. Management, again, highly aligned. Founders still involved, owns 13% of the company, so we like that one as well. So final slide, please, Tim. Thanks for the opportunity to have a chat. This is the happy to take any questions across any of the stocks or IPO candidates.
Thanks, Daniel. Good presentation there. Firstly, how do investors access you? I always think investors should have access to fund managers in this space as well as some holdings themselves. How do they access the fund? Yeah,
so here, Tim, you can definitely get in touch with client services at Copia Partners. We also do have you can access us via financial planners, and we're on most of the platforms.
Okay. And can you tell us a little about the IPO market? We believe there's kind of at the ASX, there's a mad rush, given the end of years, there's a mad rush to market. Is that what you're saying?
Yeah, absolutely. Like we're spending plenty of time in processes. As a fund to scale, we definitely get more opportunity to invest in IPOs, and we do get probably an extra 2 or 3 meetings via a cornerstone process. And so before the IPOs actually launch, companies will talk to a few, relatively larger funds that can underwrite their deals. And we're spending a lot of time in these sort of meetings, coming into contact with management teams for IPO candidates and doing a lot of work trying to understand their businesses.
And how active are you in terms of turnover? We know one small cap manager, for example, has probably taken 100 placements in the last 12 or 18 months. How active are you in terms of your turnover and your time frame in terms of holding an investment?
I typically, a lot of the stocks we do own, we have held a number of stocks for a number of years. Turnover is reasonable for a micro cap and small cap fund. We don't take every placement and trade every placement, but we do take a few and try and ultimately find quality businesses that we want to hold on to. But we do have an event-driven portion of our portfolio as well. And
what happens when you have that success story where it goes from micro cap to small cap to afterpay in size? Do you have to reduce that holding as it grows too large for the mandate?
It can be tricky in micro. So if you do own a micro cap stock which turns into $1 billion company, typically that would be probably a bit too big, and that would actually graduate into small caps. Companies that have done that in the past are, for example, Unity, and that's probably a good example. But eventually, inside the small cap fund, we can own up to 20% inside the ASX 100. But when they go into the 100, it becomes more difficult to own in small cap.
And what do you think of the research in the market in terms of this small cap, micro cap space? Do you rely on broker or external research?
We typically read research. I would say we probably try and find our own kind of sense of our own view in terms of analysis. I try and do plenty of analysis and do talk to brokers. But it is a bit more difficult in the micro cap space. Often if the companies are less liquid, there might often be only one or two brokers.
Okay, Daniel, that's all we have time for. Really enjoyed your presentation. Love to get you back on. Enjoy your weekend.
Thanks, Tim. Appreciate it.
Next up, we have Silk Logistics Holdings, ASX code SLH. The company primarily offers port logistics services, including wharf cartage, warehousing, and distribution services. As part of this service, they serve a variety of industry segments, including retail, consumer goods, food, and light industrials. It's got a market cap of around 170 million. We have with us the Managing Director, Brendan Boyd. Brendan, over to you. Thank you.
Thank you, Tim, and thank you to ShareCafe for the opportunity to talk about the business today. Just by way of quick introduction, something we're really quite proud of in our business is we do have a legacy going back 100 years with the two family companies that were the backbone of Silk Contract Logistics. That business was acquired via an MBO by myself and my business partner and some other shareholders in 2014. And through a variety of shareholder changes and capital raises, we took that business as Silk Logistics Holdings to an IPO in July of this year. In terms of the business, Tim touched on in terms of what we do, and if we just look at that next slide, Tim, there's a couple of critical points I'd like to draw attention to here. We describe ourselves as a technology-enabled port-to-door logistics provider. And one of the key lines here is we are asset light. Daniel touched on some of those challenges confronting the supply chains and the logistics industry generally. Our view is the business model that we're bringing to market is really standing up well under some of those pressures. If you look at the business, you can see there we have that physical supply chain that we service. We do own some fleet in the wharf cartage, but it is generally very specialised fleet that we can get a 24/7 utilisation out of. Other than that, our warehousing operations are all leased, and our distribution network is a virtual network of 60-odd carriers across the country. That physical supply chain is then mapped into what we think is really a unique proposition, and that is we use a control tower platform that Silk has the exclusive rights to here as a 3PL operator in Australia called One Network. And effectively, anywhere our customer product sits within that supply chain, we can provide our customers visibility of where their product sits. It's a unique part of what we do, along with that asset-light operating model that we've talked to. Thanks, Tim. Just in terms of the business overview, these are some numbers from FY21. Strong revenues and growth from prior years. And really, FY21 for us was the culmination of 2 to 3 years of hard work of acquisitions and bringing the business together. And we've really now laid a very, very strong platform for ongoing growth. And really the purpose of coming to market in terms of listing our business was really to give ourselves access to that next level of capital to take advantage of what remains a highly fragmented market that we operate in across those service lanes that we described earlier. Just some quick highlights: revenue growth, year on year of 28%. We've had a 7-year average CAGR of 19% since we completed the MBO in 14. And certainly, despite some challenges in 22 as listed by Daniel, we're certainly seeing some good pull through of the new business that we generated last year, and we're continuing to win new business this year, which is really positioning the business well. Some critical things: the average relationships with our customers is 6 years. When we win customers, we keep them. And across our top 20, that tenure is 9 years. Why do customers stick? It comes back to that technology platform that we're delivering our service on is something that customers cannot access easily elsewhere in the market. Our customers, as Tim described, generally blue chip, large global corporate customers who value the sorts of service capabilities that we're bringing to market. The business continues to grow. When I led the MBO, we turned over 75 odd million, and we were losing some reasonable dollars. But to Daniel's point, and Daniel is one of our investors, John and I have significant skin in the game, and we are very keen to continue to drive our business as we look forward to continue the growth story that is Silk Logistics Holdings. Just to the next page, thanks Tim, just a bit of a breakdown of the segments. We talk about Silk in two parts: the port logistics operations that Tim talked to, which is really the movement to and from the port of containers. So we do as much export as we do import, and it's a very strong and growing part of our business. It gets us the hands on the freight ahead of our competitors. That part of the business has been where we've been acquiring. As we look forward to 22, we're now looking to acquire in our contract logistics business area. But both of these businesses, as you can see, continue to perform well. And certainly one of the key things for us as we look forward into 22, we picked up $46 million worth of new customer revenue in FY21. About 2/3 of that was reflected in our result in 21, and we're now pulling that through into our FY22 revenues, along with circa $15 odd million of revenue that we've won in these first couple of months of FY22. So I think the key for me, thanks Tim, the business with the model that we've got, that asset-light, agile operating model, we are able to adapt to the market, and we're navigating some of those challenges and have been doing so since the beginning of the pandemic in February last year. Our revenue and earnings continue to grow at rates that we think are as good as any in the market. Our asset-light model really allows us to bend the business relative to some of those disruptions. And we've seen instances such as MUA strikes, dislocation ex-China with shipping, which in a business that is heavy with assets, it is difficult to manage your workflow and your workforce and your assets and to remain cost competitive. In our business, we have the ability, given our asset-light model, to turn resources on and off relative to demand. And I think over the last 3 months, despite those challenges in our industry, our business is continuing to perform at or above our FY21 levels of performance. So we're a great believer in the business model and the technology that we're bringing to market. And we certainly see that being a critical aspect for FY22 and beyond. Just to touch on some of those other aspects coming out of COVID, there's obviously been a shift from what's been a traditional B2B market for us into more B2C. And as a business, we've had to contend with that and start to look to build B2C capability within our network. We're looking to fast track that with some acquisition, hopefully over the next 3 months in that space, given the demand we've got from customers who have traditionally been bricks and mortar B2B, really accelerating their penetration into that B2C environment. The other key point I'll probably call out is just labour. And I'm sure people will have talked about this, but there is a real war for talent. And good people are getting more and more difficult to find in what's been a challenging market, be that blue collar or in our white collar workforce. And certainly a key focus for us in FY22 is our employee value proposition and how we really refresh that to attract the very best talent available to us to continue to allow us to build the business as we move into FY22 and beyond. Just to close it out, thanks, Tim, in terms of the last page. These are the numbers from our prospectus. I'm pleased to say we're tracking well in terms of these numbers, and indeed we're seeking to probably provide some trading update over the next 2 to 3 weeks relative to how we're tracking for this year. There is that uncertainty. It is around our business is coping well. We think we're working well with customers who are voting with their feet in terms of the model that we're bringing to market. And we're very confident that the Silk growth story will continue in the coming 12 months. Thanks, Tim.
Thanks, Brendan. You're in a really interesting space. Obviously, COVID's impacted. There's been a lot of inventory build-up. There's a lot of talk of blockages at the ports and COVID. Could you give us a little bit more colour on what that's meant and how you've had to manage that?
Yeah, look, very early days, Tim, there was an absolute exodus of inventory out of our sheds, and we got left with fresh air, which is not a great space to be when you're managing warehouses. What we've seen in response to that is customers are ordering well forward, and the old just-in-time principles in our industry have gone out the window as customers look to secure inventory. So there's been a bit of that stockpiling occurring over the last 3 to 6 months. There is some dislocation at the moment with shipping, but we see a very strong next 2 to 3 months of shipping inbound into Australia, really addressing that situation.
And there's a question in regards to shipping here. Does your revenue correlate with shipping costs?
Now, look, ours is very much domestic, so our customers, unfortunately, do wear those shipping costs. Our job is to make sure we streamline the movement of those containers through their supply chain and get them back out the other end, so they're not adding demurrage to the pain of those shipping costs.
And another question: what sort of market penetration do you have, and therefore what sort of growth runway is over the next 5 to 10 years?
Yeah, look, we've done some work, and in those market segments that we play in, Tim, we think there's a contestable market there for us, circa $32 to $33 billion. So we think we've got significant runway for growth above our $350 million that we'll do this year.
And a question here in terms of how much penetration do you have with that existing customer in terms of that end-to-end logistics?
Yeah, look, when we started out, the central plank of our business was really our warehousing operations. 85% of our warehouse customers use 2 or 3 of our service lines. We're now focusing our share of wallet energy, particularly into the distribution space, where we see a really fertile sort of opportunity over the next 12 months.
And we always get a question on competitions. What is your biggest competitive disadvantage compared to some of the bigger port and logistic operators?
Yeah, look, we don't really consider ourselves a disadvantage, Tim. We bring a different model to the market. It's very service focused. We're not chasing large volume and bulk volume, such as a Cube might do. And we're very strong in the belief that our service focus and technology-enabled delivery of that is really why we're continuing to grow double-digit in our organic growth.
And can you give us a little bit more colour on the exclusive rights that you mentioned over the technology that you have in your business?
Yeah, look, the One Network platform is a US-based system. It's available to the Coles and large grocery guys, but as a 3PL operator here, we have the rights to operate that system and on-sell that system here in Australia. It's effectively a control tower platform. It is up there as number 1 or 2 in a global ranking, and it gives us that ability to bring disparate networks together and present them back to our customer as a single view of the truth.
And in terms of M&A, you spoke about that. Can you give us a little bit more colour on the verticals that you target? Does that come from the growth of online, for example, relative to bricks and mortar?
Yeah, look, certainly in the near term, we hope to secure an acquisition to really enhance our capability in that e-commerce fulfillment space. And then we're looking to expand our footprint in the port logistics space into West and South Australia, where we are suboptimal at the moment. So they're really our 2 focus points in the short to medium term.
Right, Brendan, that's all we have time for. Really enjoyed the presentation. Love to get you back on. Enjoy your listing as an ASX company.
Thanks, Tim. Appreciate your time.
Okay, next up, we have Cobram Estate Olives, ASX code CBO. The company is a vertically integrated producer and marketer of olive oil products. The strategy is to go from vineyard to bottle through to growing, bottling and storage facilities. Company has market cap around 775 million, ASX code CBO. And we have with us Sam Beaton, who is the joint CEO. Sam, over to you. Thanks.
Thanks very much, Tim, and thanks to ShareCafe for hosting me. If we could just move to the next slide, please. One more. Cobram Estate Olives Limited, we listed on the Australian Stock Exchange in August 2021, but we've been around for over 20 years. And during that time, we've built one of the world's largest vertically integrated olive oil businesses. We have operations both in Australia and in the USA in the state of California. In Australia, we're fully vertically integrated. We have over 6,500 hectares of olive trees. This year, we produced just over 16 million litres of olive oil, which is around 71% of Australia's olive oil production. We have a 45% market share of the extra virgin olive oil category in Australia through our premium brands, Cobram Estate and Red Island. In the USA, we're also vertically integrated. We have just over 300 hectares of our own grows. We have a processing plant, storage facility, bottling line, laboratory, and a sales and marketing function. And we've really seen really strong growth in sales, particularly in the last 2 years in the USA, where we have packaged goods sales over $30 million. Just move to the next slide. This is really a chart just demonstrating our vertical integration, which I've talked through, but we have full vertical integration in both our Australian and USA operations, right from the nursery through to the consumer or supermarket shelf. Next slide, please. In terms of getting you a bit of a feel for our growth strategies, and we've had 4 growth pillars that have been very consistently applied and communicated over the last 5 years, and certainly what we use internally to remind all staff of where our growth focuses are. And the first of those is increasing supply from our Australian groves. And over the last 7 or 8 years, we've replaced a lot of the underperforming varieties with better performing varieties. We also spend a lot of time, money and energy on efficiency improvements. And that's from growing to varietal to harvesting efficiencies and processing techniques right through that chain. And just as a reminder, we have, with all the redevelopment and planting programs, we have around 39% of our olive groves in Australia, which are yet to reach maturity, which is around year 8. Our next growth pillar is growing the business in the USA, the fully vertically integrated business. And we're really excited by that opportunity of really replicating what we've done here in Australia, in the Australian category. In the short term, our focus is on increasing supply by planting our own olive groves and really being able to capitalise, or allowing us to capitalise on the opportunity to continually grow packaged goods sales, both through our branded product and private label. Our fourth growth pillar is increasing the net return or value that we receive from each litre of olive oil that we sell. And we have a really disciplined approach to this and have continued to increase that margin or return over the last 5 to 6 years. And the fourth pillar, and certainly not least important, is valuating our olive byproducts. We're 99% of our waste we reuse within our operations, but certainly not at the highest and best use. And we're spending a lot of time and money on researching and developing new products by using the value that's left in the olive oil byproducts, and certainly adding value to that, and not only decreasing that to cost neutral, but certainly profitable going forward. Next slide, please. Just to give you a feel for our Australian operations and what we've done there in terms of our redevelopment and replant program. You can see from the chart on the bottom left-hand corner, we produced just over 16 million litres of olive oil in the harvest just finished. And as you can see, importantly, that result was from over 1,000 hectares less of mature trees, which is really a reflection of the replant program that we've been through in redevelopment by planting better performing varieties. And we'll continue to see that increase as the grove matures. Next slide, please. In terms of our growth from our Australian operations, there'll be significant organic growth as our trees mature. You can see the chart on the bottom left-hand corner. This shows the mature hectares by year over the next 10 years. And at the moment, around 4,000 of our 7,000 hectares is fully mature. Within the next 10 years, we'll see that rise to around 7,000. The chart on the bottom right-hand corner, this just shows the hectares by tree age on the left-hand axis, and the line is the maturity profile of a tree in litres per hectare on the right-hand side. So as you can see, an olive tree doesn't produce a crop until year 3, and then will be fully mature in year 8. And our groves produce around 2,400 litres per hectare, and that takes into account a replant program. So we model all our yields based on continually replanting around 2.5% of our grove every year, which means we'll effectively have an asset that runs into perpetuity. But the 2,400 litres per hectare takes that into account. In terms of water, and this is really important, certainly for those of you that follow any agri stocks, and our strategy is to purchase water on the allocation or the temporary market as and when we need it. And there's certainly been a misconception around permanent water or entitlement water, and that is that a lot of investors think that if you own permanent water, then you have water security, which is not actually right. A permanent water right, you are only allowed to use the water attached to that if there's an allocation announcement, which is governed by the water authorities. So it certainly doesn't give you security around water. And we've chosen to purchase water as and when we need it, and certainly is one of the top gross margin dollars per megalitre of water that we use. We're very, very comfortable, and we've never had an issue purchasing water. But of course, we are subject to the fluctuation in water price. And as you can see from the chart on the top left-hand corner, the water price has fluctuated over time, and certainly the drought years of 19 and 20 significantly higher than where they are now. Over the last 8 years, we've purchased water for an average price of $233 a megalitre. The last 12 months was 168, and this year, pleasingly, it's trading down towards about $120 a megalitre. The storage levels are over 80% in the southern Murray-Darling Basin, which is where our storage levels are, and that compares to 57% in the middle of August last year. So certainly in a very good position, and a strong outlook for low water prices in the next 12 months. In terms of the USA, we have 4 Grove sites in the USA, just out of Sacramento, in between Sacramento and San Francisco in California. We have over 300 hectares planted. We have another 450-acre grove that we'll plant the next 12 months, and certainly committed to continuing to plant our own production assets each year, and really helping drive that increased supply year on year, which will enable us to capitalise on the opportunity to sell both private label and branded product through our Cobram Estate range. I just wanted to touch quickly on this because it is really important to understanding our profitability and how to think about our results. Olive trees are naturally biennial bearing, and that means that a high cropping year like this year will be followed by a low cropping year like next year. And this is a known and expected fact. But under accounting standards, you're required to measure the fair value of the crop in the year of harvest. You then deduct the actual cost of production, and then that increment is taken to your profit in the year of harvest, not when you sell it. That then sits there as inventory at that higher value, and then as you sell the oil, it goes through your cost of sales. So over a full cycle, the increment that goes through your P&L washes through your cost of sales. But what it does mean that in a high cropping year like this year, you have a higher reported profit, and a lower cropping year like last year or next year will be a lower reported profit. You can see from the chart in the top left-hand corner, this chart's our last 4 harvests in Australia in the green bar. In the light blue bar is the reported profit in that year, and you can see the reported profit goes up and down with the harvest. And in the red bar, that's the rolling average 2-year EBITDA, and certainly how we assess business performance internally. So taking into account both a high cropping year and a low cropping year. Now, cash flow is very different because we sell to our customers consistently month in, month out, and demand is certainly not seasonal. And we're able to do this by managing our inventory over 2 years. So a high cropping year like this year will supply the market for up to 16 months, and a low cropping year like last year will supply the market for around 8 months. So really leads to more consistent operating cash flow, certainly compared to the 1-year reported profit. But as I said, we encourage investors to think about our profitability over that 2-year cycle. The 2-year EBITDA certainly needs to be taken into context of the maturity profile of our assets. And as I said, around 39% of our Grove assets are yet to reach full maturity, and that will certainly drive the increase in EBITDA over the short to medium term, even though our 1-year profit will go up and down with our crop year. In terms of the full profitability of the business and the P&L summary, we have sales revenue of around $140 million. Our business we think about in 3 key segments: the Australian olive oil division, the USA olive oil division, and the innovation and value add business. The Australian olive oil division contributes the majority of the profitability, as you've seen, and the USA and innovation and value add divisions are certainly earlier phase businesses, but we've seen good improvement from both those divisions in the last 12 months. Thanks, Tim, and back to you.
Thank you. We had lots of questions about this variability with an olive farm. In fact, we have someone whose grandfather had a farm, and the production volume oscillates in alternative years. Can you kind of plant that out to balance that risk? How do you manage that risk? Can you have other assets growing at alternative times?
Yeah, that's a good point. And certainly one of our grows, we're not seeing as much of the biennial bearing. And it's typically an event that will cause it, and it'll affect the current year's crop. And then the olive tree naturally puts more energy into the growth, which is the crop for the following year. So you end up with this biennial bearing. Over time, we believe it will even out more, but certainly from an operational point of view, it doesn't concern us because we manage that oil over a 24-month cycle. So what we're more concerned about is educating investors around that 2-year cycle, because, as I said, from an operational point of view, it certainly doesn't create any issues, and from a cash flow perspective either. But there are techniques and pruning techniques that you can manage that biennial bearing to a certain extent.
It's funny because there's 4 of us here. We've all got your product in our pantry. So can you give us an idea of how you kind of maintain that premium quality offering in the face of kind of new lower cost competitors?
No, it's a good question. I think one of our competitive advantages are we are able to produce such a huge amount of olive oil, but maintain those quality parameters, and it's through our proprietary olive growing systems that allows us to do that. And it's not 1 or 2 things; it's 100 different things. And but also through that system, we're able to produce olive oil right at the bottom of the cost curve. So we've got lowest cost olive oil and highest quality. We then take all of our olive oil and we only ever allocate around 50 to 60% of that olive oil to Cobram Estate, which allows us to put the very best quality in Cobram Estate and maintain that quality premium. And then the next best, which is still very good, extra virgin olive oil into Red Island, and then into private label and some bulk customers that purchase oil from us.
And we've got lots more questions coming through, which we don't have time for. But just finally, over the past 5 to 10 years, cumulatively, the business has kind of generated minimum free cash flow and debt has increased. What's this going to look like moving forward?
Yeah, we're certainly, we've got really strong operating cash flows, and particularly as our groves start to mature, and I think importantly, the cost of producing or growing a crop is relatively fixed, no matter what size the crop is. There's some small variable costs. So as your crop increases, effectively your operating cash flow and profitability also increases. So we'll be funding our growth out of operating cash flow, and as I said, it's very strong, and the outlook's really strong as well with the maturity and the growth profile of the groves.
Great, Sam. That's all we have time for. Really great to hear the story, and thanks for your time.
No, thanks, Tim, and thanks for the questions.
Next up, we have Magnus Energy Technologies, ASX code MNS. We've been looking forward to having them on for some time. The company is a vertically integrated lithium-ion battery player. We have with us Frank Pullis as the executive chairman. Company has a market cap around 320 million and a 57% share price rise over the last 12 months. Frank, over to you. Thank you.
Thanks, Tim, and thanks for the opportunity to be able to present here today as well. So with Magnus Energy Technologies, as we'll see in the upcoming slides, if I could get you to move down to our vision. Yeah, thanks. We are a key global player in the lithium-ion battery supply chain, production and so on. It's something that's really unique, especially in the local marketplace. We're not producing a raw material or some technology that goes towards the lithium-ion battery. We're actually doing we are that integrated battery play where we're talking from raw materials to the technology to actually manufacturing the cells that would go into, whether it's an EV or an energy stationary storage type product. We're there from end to end. And it's something that I think is not only unique in the local marketplace, but actually unique globally when we start talking about lithium-ion batteries and cells. And, on the topic of today's conference, a hidden gem, I believe in the battery space, Magnus is a hidden gem, and it's probably one of those stories that isn't as well known in the marketplace. But we have been working at this for a long time in the background. So when you see sort of some of these plants and the technology and our mine as well, and at the stage it's at, do realize that from sort of where the mine is today, or from where these battery plants are, we're talking about minimum 5 years to sort of 8 years, and the battery tech's sort of more than 10 years as well. So it's sort of, while the story might seem new, it's not so new, and there's been a lot of work that's gone in the background to get us to where we are today. We talk about our global opportunities and a rundown of the company on the next slide. So there's the New York battery plant, which we'll go into more detail quite soon. Our natural graphite project, and I mentioned previously about the mine, and then there's also an Australian project in Townsville. There's just, the corporate overview numbers around, share price, market cap, cash, which is a consolidated cash position between our Magnus position and the New York entity, with the New York entity roughly being 60% owned by Magnus. We've got to consolidate those numbers. And we go into greater detail of that corporate structure in the next slide, which shows Magnus Technologies and the various sort of ownership levels that we have in our different sort of entities that we're involved in. So firstly, on the cell manufacturing, there's roughly 60% owned of IM3 New York. There's the Townsville project, which I mentioned, at 33%. There's C4V, which is a battery technology company, of which we own just under 10%. And then the mine in Tanzania, which is 100% owned by Magnus. The next slide talks about the board of management team. And I think for a company of our size, we've got some really unique individuals, and hence why we're sort of highlighting it in, our quick sort of presentation here today. But, and headed and first and foremost by Professor Stanley Whittingham. So for those who are unfamiliar, and I'm sure most of you who know the lithium-ion battery space will probably be familiar with Professor Whittingham, but Professor Whittingham was awarded with the Nobel Prize in chemistry in 2019, and he's actually the original inventor of the lithium-ion battery. So, talking about, the sort of the battery manufacturing and sort of being involved in this industry. And if you want to sort of talk about, who do you guys have that will allow you to compete with, some of the majors out there, or to be a major player in this space? Well, you've got the inventor of the lithium-ion battery, that speaks volumes. And, Professor Whittingham's still active in this space and still works to this day full time. So, to have him on board is obviously a huge privilege, but, also shows that we've got people like Professor Whittingham who believe in what we're doing. We've got, Dr. Richard Petty has been on the B20 task forces for finance and infrastructure in the past. Mona Dejani, who in the renewable energy space is a key contributor, and has worked on many government projects for the current US administration and previous administrations in the past. And Zarmeen, who is an ESG expert, Peter, who looks after everything on the Tanzanian side of things around the mine, and Mugunthan, who is quite well known in the funds management industry. So what I believe is a really impressive board for a company of our size. And I think that goes down to, what we're doing, and, having people that actually believe in Magnus and, the potential that exists out there as well. We'll talk about the New York battery plant next, and that's probably, I would say, the project that we're really focused on in the short term. And for those who follow the company, we're providing updates every few weeks, and we will continue to do so. There is a lot of work that's taking place over in Endicott in New York at the moment, of which, as mentioned, 60% of it is owned by Magnus. We are fully funded to 1.8 gigawatt hours worth of annual capacity or production. What does that mean? Well, as of today, it would be one of the top 3 plants in the US. There are a number of plants that are coming online in the near term that will be sort of larger, but then we're scaling up as well. As you can see, one of the points here is by 2030, we plan to be at 32 gigawatt hours, and internal targets are even more bullish from that point of view as well. It is really important to also talk about the batteries we plan to produce. This has been independently verified. It was a report that was funded and commissioned by NYSERDA, which is the New York State Energy Research and Development Authority. They used a group called ABT Associates, which is a well-known consulting group, to look at the life cycle analysis of the production of our lithium-ion batteries and versus other majors in the lithium-ion battery space. And their report said that we would be producing some of the greenest batteries in the world, and comparing it to some of the other producers in the marketplace right now, we're talking about in some aspects over 80% less toxicity levels than our production. So we're talking about US production with a non-China supply chain with some of the greenest batteries in the world, for the US market, but also for other markets as well. But mainly for the US. So as you can see, it's a really exciting project here. And that entity has the exclusive rights for all manufacturing, cell manufacturing patents from C4V. So, and C4V's got some great technology. C4V has been mentored by Professor Whittingham sort of since inception. So we're really excited about what we will be able to produce. And as the slide brings out, 4.4 million cells annually at that 1.8 gigawatt hour production rate, which, as we mentioned, we plan to increase as we go forward. The next slide talks about the current plan update. So as of the end of August, 29% complete. We will have an update in the near future that will give that number at the end of September. There is some great progress being made, especially since that air permit was officially granted by New York State. And that has allowed us now to start construction of the dry room. So what you have is you construct the dry room and then the equipment goes in there. And so that permit was imperative for us going forward. And for those following the company or who will start following the company, you will start seeing that the completion and that percentage really increasing now in a big way. We talk about Townsville in the next slide. Townsville had a feasibility study that was completed last year. We are looking at ways of fast-tracking production, whether it's cells that are coming from the US plant to potentially be having a battery assembly plant locally. We are looking at all options. So, the aim is to grow as quick as we can, exponentially as quick as possible. We are doing that in New York, and we're also looking at options locally as well. And you just have to pick up a newspaper any point in time, and you'll see it's all about sort of renewable energy and sort of green energy going forward. And we want to play a role locally as well. We'll briefly talk about our battery technology in the next slide. So that was one of the aspects, and we will be producing our BMLMP technology. With some out there, you will probably be familiar with NCA and NMC. NCA is traditionally what's being used in a Tesla car battery. They are using now LFP as well for their Tesla Model 3s. And as you can see, if you look at the comparison between the technologies, you could see things around, speed of charging, but main safety energy density, cost. We sort of tick a lot of those boxes there, but sort of some of those key ones are safety. Our batteries are extremely safe, and that's been independently verified as well. Versus the sort of traditional technologies, and then cost and lifespan. These are long-lasting batteries, and traditionally at a cheaper cost purely because of the raw materials that are going into it. The next slide goes a bit more into that technology, the fact that it's a non-China supply chain. We don't have any cobalt or nickel in our batteries, and you could see the Sioux Energy, the capacity and the voltage comparisons between the technologies that are traditionally used in the lithium-ion battery space right now, and we compare very well. Especially, we have got a low. Our batteries are at low cost versus some of our peers in the marketplace. Like, as in by peers, I mean the technologies being NCA or NMC, and we're at the cost of sort of around that LFP price. But as you can see, from voltage capacity in Sioux Energy, we're in a different league. And as I mentioned, the Tesla Model 3 is using that LFP technology. So it all bodes well for our tech going forward. We touch on the anode materials from our Nachu graphite project on the next slide. We are able to produce a battery grade anode material without the use of any chemical or thermal purification. We are working towards off-takes in the lithium ion with groups that are providing into anode materials into the lithium ion battery market. We believe that we're working towards getting an offtake in the near future, and we've got it in our timeline for this quarter for our graphite, which is the next key step towards getting funding for our project. So we need to get those offtakes and those customers in first prior to getting that funding, and we have been making some great progress. And for those who follow our announcements, we recently had a site visit from a North American group who's looking at signing offtake with us. On the next slide, we start talking about our next key milestones. We've commissioned sort of first production, which was our manual production. Semi-automated will begin this quarter, which is quite exciting for us, and that will start producing thousands of cells, and mainly will be used for marketing purposes and testing purposes. We then are looking at next quarter, talking about a listing in the US. We've recently brought in a person full-time for IM3 to look at that, and he's making some great progress there. And we're sort of, looking at potentially a SPAC listing, and in the form of the listing for that entity in IM3 New York. And we are talking about some government funding. For those that are familiar with President Biden's infrastructure plan that was passed through recently, there's roughly 17 billion US towards helping cell manufacturers grow exponentially. And it was for those who are either in production or about to be in production. So we're all over that, and we have had a number of meetings with the DOE regarding that program. On the battery tech side, we've been announcing our extra fast charging results and our fast charging results. We mentioned in the past the New York extra fast charging bus program. We will have some details about that this quarter. On the anode materials, as I mentioned, or our mine offtakes for our graphite, and finalizing our funding for Nachu next quarter. So you can see some really key milestones that we're sort of right in the midst right now, or some, literally a quarter away. So it's a really exciting time for the company. And then talking about the sort of investment rationale in the next slide, we've got sort of, we believe the project and the company ticks the boxes from, the green aspects, to being sort of a near-term revenue play as well, and all those ESG sort of aspects that people are looking at in these days. So thank you so much for your time and for hearing the presentation, and thanks, Tim, for the opportunity.
Thanks, Frank. Appreciate that there is, I've just lost my light. Appreciate that there's a lot to get through in that 10 minutes. Now, there's lots of questions here about your listing. And just for clarity, it's IM through New York that would list offshore in the States, but not Magnus per se.
That's correct. There's sort of two different aspects, Tim. We've spoken recently about we're upgrading the listing in Magnus from the pink sheets to the OTC market, which gives people greater access to be able to trade Magnus's shares from the US. But when we're talking about the listing and a SPAC or whatever it may be that assists us in getting this listing over the line in the US, it's for IM3 New York.
And we know that you're kind of end to end in terms of owning a graphite mine and taking it all the way through to cell manufacturing. Believe it or not, there's some questions here about recycling. Could that be part of the equation in terms of what you would look at?
So with all our projects, and especially the one in the US, there is recycling there as well. So it's one of those key aspects that's part of any projects that we look at. From a Magnus point of view, though, I don't think that we would be getting involved from that aspect, but our projects will have recycling technologies involved with it. There's a number of groups our guys in the US are working with right now, and on the recycling side as well, and various technologies in that aspect.
And we understand you have kind of confidential contracts in place, but there's questions in here as in, who are your battery customers, and what do they look like, I suppose? Who could potentially use this product, and what would that look like?
Look, one example, and one that we've announced in the past, is a group called Martech. So Martech produces unmanned boats and automobiles, mainly for government purposes. And our battery packs are in their products right now. So they were produced from our sort of pilot plant, which is out of a university close to where our battery plant will be based out of, but using our technology. So that's one sort of customer, so government supplier that supplies these unmanned boats and vehicles for mainly to the US and British governments.
And funding obviously becomes critical, and governments and government funding is obviously opening up in this space. You've got a well-credentialed board. How much do they help you in regards to those conversations?
Yeah, look, they're huge in that. And especially when we're talking about funding, especially around our project in the US to help us get to double-digit gigawatt hour capacity, having Professor Whittingham and especially also Mona on the board is imperative. And as I mentioned before, Mona's worked with on a lot of projects with the US government, especially around the Department of Transport and the DOE, and Professor Whittingham as well on with DOE projects as well. So, I think the project sort of speaks for itself. It's, a non-China supply chain in the US. It's growing, it's got this whole sort of made in the USA for the USA type, banner and focus on the project. But yeah, like we are very confident with sort of the guidelines around that funding that is available out there. We believe we'll be able to tap into that. And we have, in previously announced funding from New York State government as well towards the project.
And Townsville, the Townsville facility is part of, have you spoken to state government there in regards to funding as well?
So the state government, the Queensland state government provided us the funding for the feasibility study. There's discussions with all forms of government at the moment, but what has sort of been, from my aspect, really encouraging is a lot of the groups who you read about in the papers daily, who are providing batteries locally for our local market have all been reaching out to us because currently they're buying cells, whether it's from the Chinese and mainly from the Chinese, have reached out saying, look, we would love to support, an Australian company and an Australian manufacturing plant as well. So that's been highly encouraging, where I believe that some of these groups will be off-takers of us, not only from New York initially, but form the basis for our manufacturing plant in Townsville as well.
And you've got around $1 billion worth of kind of contractual commitments. How active is this space now? I mean, you've been in this industry for a while now. Do you have a lot of potential customers coming to you?
Yeah. So right now, there's roughly about 30 customers that are going through like a qualification stage with us. And it's one thing it's a great question, and one point that I think I've got to sort of highlight. In order to get these types of agreements and these contracts and contracts that we've announced, groups go through a qualification process, and usually it's sort of like a minimum sort of like a 2-year process. And these days groups are trying to fast track that. So it's important to know, and this goes for groups like who might be locally listed companies here or overseas who are looking at producing anode materials or cathode materials, to then get cell manufacturers to actually buy their materials. They've got to go through a qualification process, as we have done with our cathode or our anode supplies and so on over the years. So we have got an active list. We always get the question whether there's, any EV players, out of the US or Europe. Yes, there are. But in saying that, the disclaimer there is we need to be up and running with production in the first instance before you get contracts signed with the bigger players. And Herbert Diess, the CEO of Volkswagen, has made that clear in the past. He sort of put out a call saying, if anyone's producing at gigawatt hour scale and isn't talking to us, reach out to us. And that's the key. You've got to be in production, one, to also meet the amount of cells that they're after, but also they want to make sure that you're up and running. We're talking about our fully automated production being roughly 6 months away, so it's we're very close to that period, but we are in qualification programs with EV players as we speak right now.
And obviously there's been some press around your contracts and who they are. And I suppose what investors don't understand is kind of the process in the background. I mean, a lot of these are confidential. There's NDAs signed. Can you talk about who qualifies those contracts in the background?
So thanks for bringing that up, Tim. So when it comes to our contracts as well, as I mentioned, the end users go through a qualification process. So it's not like someone comes to you tomorrow and says, look, we want to buy some batteries. We like the fact that, it's a non-China supply chain and we'd just like to buy your batteries, and here we'll just sign an agreement. One that's been sort of publicized recently is a group called Sioux Energy. That's sort of their name came out in the media. We've gone through literally 4 years of qualification with this group to get to a point that, they were ready to sign a contract with us. And that is something that is, common across the board. From our side as well, you've got to remember you've got a sector that is, when you start talking about the supply of cells, it is very tight currently. And as an example, we're looking at a project overseas in Asia where they were looking at putting one of our containers with a bunch of cells at the back of stabilizing the grid. And because of the volumes of cells, we would potentially look at going out there and sourcing those cells from one of the current majors. The shortest lead time we could get was 5 months. So that's how tight the market is. So when you're an end customer and you're currently buying cells off some of these groups, the last thing you also want to do is go out there and say, going forward, we will be buying cells from IM3 New York, when those customers have got, people knocking on their door right now saying, look, we want to buy cells. And they're telling them, look, there's a 5-month lag. Now, we're not saying that those customers will only buy off us. we will be one of their suppliers, but it's so tight at the moment, and it's also, as you mentioned, it's not a sector where people, name names and quantities and prices that they're buying, sells, and so on. There's very limited data on those things. So it's, just to give, the audience, a bit of an understanding. You don't traditionally announce volumes from, gigawatt hours or megawatt hours, and, the price that you're selling to each customer at, because every customer's buying at different prices depending on volumes they're purchasing and what has been negotiated with them. So it's a bit of a complex market when it comes to that. But seeing that we're near-term production and near-term revenues, people will be able to start seeing, revenue numbers around the New York entity and profits that it'll be generating and so on, seeing that we're so close from production.
And just finally, this question is still around the kind of New York listing of your battery factory IM3. The reality is, are you doing that because it gives you access to capital and also has the potential to realise value for Magnus shareholders in terms of your 60% stake in that business?
So firstly and mainly, it's, to access capital, to be, brutally honest. In saying that, I think there could be a huge re-rating in Magnus's share price as well. When you look at cell manufacturers in the marketplace and the valuation that is put on them per gigawatt hour, and for those out there, have a look at CATL in China. They're a pure cell manufacturer. Look at their market capitalization and look at their production in the last sort of 12 months. And derive the valuation per gigawatt hour. And literally, if, the most recent numbers I looked at, which was probably about 4 weeks ago, and I'm not sure as to where they are today, there was roughly a valuation per gigawatt hour, somewhere around that $4 to $5 billion US dollar mark. New York has capacity of 1.8 gigawatt hours with no shortage of customers. Owning 60% of it, there could be a potential for huge upside there for Magnus. But answering the question, getting access to capital first and foremost, but I think there'll be knock-on effects for Magnus shareholders and for Magnus itself as well.
Thanks, Frank. That's all we have time for. It's certainly a theme and a topic that is prominent in the press that we see all the time. Good luck out there and have a good weekend.
Thanks so much, Tim. Really appreciate it.
That's all we have time for. Have you back next week. Thanks for your time. See you later.